Welcome to The Explainer. Today we're cracking open Amazon, but probably not the company you think you know. We're diving into a really fascinating equity research report that argues there are actually two very different companies hiding inside this one giant.
So, let's start with a bit of a puzzle. We all feel like we know Amazon, right? But if you look at its recent financials, there's a twist in the story that's pretty surprising. On one hand, you've got experts who are really optimistic. But on the other, a super important financial number looks, well, it looks terrible. So what's really going on here?
And this is that number, a 48% drop in free cash flow. Now, this is a metric that investors watch like a hawk. It's a key sign of a company's financial health. A drop this big is staggering. It's the kind of thing that would normally send people running for the hills. So what on earth is happening?
Well, the secret to solving this mystery, according to the report, is that we have to stop thinking about Amazon as one single company. Because it's really not. It's two completely different businesses just operating under the same roof.
Okay, first let's look at revenue, where all the money comes from. And this chart pretty much confirms what we'd all expect. This is the Amazon we all use every day. More than 60% of all the money flowing in comes from that massive retail empire, the online store, and all the services for third-party sellers. No big surprises here.
But revenue is only half the picture. When we switch over and look at profit, the whole story flips on its head. Look at this. That relatively small slice of the pie we saw before, AWS, Amazon Web Services, is actually generating a whopping 58% of the entire company's operating income. Let that sink in for a second. The retail side makes most of the sales, but it's the cloud business that's making the real money.
So there you have it, the two Amazons, side by side. On one side, you've got the giant, sprawling retail operation we all know, and on the other, you have a smaller but wildly profitable tech engine, powered by AWS and advertising. And understanding this split is the absolute key to understanding everything else about the company.
So, if that's the real picture of Amazon, why are so many experts feeling bullish, optimistic about its future? Well, the report says it all comes down to three main pillars of growth.
The whole optimistic case is basically built on these three ideas. First, the cloud business, AWS, is about to get a massive boost from AI. Second, the retail business is quietly becoming way more profitable. And third, its advertising arm is a monster of a business hiding in plain sight.
Pillar number one is all about AI. The report makes a fascinating point. It says that while a lot of competitors got headlines for AI training, Amazon is perfectly set up to win the much, much bigger market of actually using AI, which is called Inference. Here's a good way to think about it. AI training is like building a revolutionary new app. It's tough, it's expensive, and it gets all the press. But Inference is like having millions of people actually using that app every single day. That's where the real long-term money is, and that's where AWS is set up to clean up.
Pillar number two is that retail business. The one that doesn't make a ton of profit? Well, that's changing. It's getting way more efficient. Its operating margin, which is basically how much profit it makes on each sale, just hit 7.5%. That is a huge jump. And the reason why is that after years of pouring money into robotics and regional warehouses, their shipping costs are finally growing much slower than their sales are. It's all starting to pay off.
And that brings us to pillar number three, Amazon advertising. This thing has quietly become the company's fastest growing segment. It's an insanely profitable business that runs on all of Amazon's shopper data, and it basically acts like a funding machine for the rest of the company, paying for other innovations.
Okay, but it's not all sunshine and rainbows, of course not. The report is also really clear about the major risks and headwinds that Amazon has to navigate.
For one thing, the competition in the cloud is absolutely fierce. I mean, sure, AWS is still the king of the hill with 30% of the market. But look at these growth rates. Microsoft Azure and Google Cloud are both growing significantly faster. That puts a ton of pressure on Amazon to keep innovating just to stay on top.
The second major headwind is regulatory pressure. Governments all over the world are looking at Amazon's market power with a microscope. This leads to massive fines, like this recent $2.5 billion settlement, and it creates this constant risk that regulators could step in and force big changes to how Amazon does business.
So with all that in mind, where does that leave us? Let's bring this all together and finally solve the mystery of that scary-looking number we started this whole thing with.
Right. Let's circle all the way back to that minus 48% drop in free cash flow. After everything we've just gone through, how do we make sense of it? What's really driving that number?
Okay,
To understand this, we just need a quick definition. Free cash flow is simply the cash a company makes from its normal operations minus the money it spends on big, long-term assets, which are called capital expenditures. A simple way to think about it is like your paycheck minus any huge one-time purchases, like a down payment on a house. It's the cash you have left over after all the bills and the big investments are paid for.
And here's the answer. The cash flow didn't drop because the business is making less money from its operations. It dropped because the second part of that equation, the spending on big investments, absolutely skyrocketed. It went up by 80%. So the real question isn't why is cash flow down, it's what on earth are they spending all that money on?
And that's the absolute crucial point here. That cash flow drop is a deliberate choice. Amazon is pouring tens of billions of dollars into building out the data centers and the infrastructure needed to power the next generation of artificial intelligence, the very thing that underpins their single biggest growth pillar.
And that is why the report's final verdict is so optimistic. It argues this period of heavy spending isn't a sign of weakness at all. In fact, it's the exact opposite. It's a strategic investment that for anyone focused on the long term might just represent a compelling opportunity.
Which leaves us with one final thought. What if that shocking number we started with isn't a warning sign at all? What if it's actually the clearest possible signal of where one of the world's biggest companies is placing its biggest bet on the future?